What if I told you that 2026 could be the year you finally break free from living paycheck to paycheck? The year you build real wealth? Here's the truth most people won't admit. Getting rich is not about making more money. It's about making smarter decisions with what you already have. I recently analyzed the habits of self-made millionaires, and I discovered something shocking. They all started with 5 simple money habits that anyone can implement today. We're talking about strategies so powerful that they can completely transform your financial situation in less than 12 months. The best part? You don't need a 6-figure salary to start. You don't need to be a finance expert, and you definitely don't need to take massive risks. These are practical, proven habits that work whether you're making $30,000 or $300,000 a year. But here's the catch. Time is running out. We're already into 2026, and every day you wait is another day of potential wealth slipping through your fingers. The people who start implementing these habits today will be completely different financially by the end of this year. In the next few minutes, I'm going to break down each of these 5 game-changing habits step by step so you can start building wealth immediately. But before we dive in, smash that like button if you're serious about transforming your finances this year. Let's get into it. So let's jump right into the first habit that separates wealthy people from everyone else. And I'm telling you, this one alone could completely change your relationship with money. It's called the reverse budget method, and it's the exact opposite of what traditional financial advice tells you to do. Here's what most people do wrong. They get their paycheck, they pay their bills, they spend money on groceries and gas and going out with friends. And then at the end of the month, if there's anything left over, maybe they save it. Maybe. But usually there's nothing left, right? You know exactly what I'm talking about. You look at your bank account on the last day of the month and you're thinking, where did all my money go? I felt like I just got paid yesterday. The reverse budget method flips this entire system on its head. Instead of saving what's left over, you pay yourself first. The moment your paycheck hits your account, before you do anything else, before you pay a single bill, you automatically transfer a percentage of that money into a separate savings or investment account. This isn't optional. This isn't something you do when you feel like it. This is the first transaction that happens every single time. Now, I know what you're thinking. You're saying, but I can barely afford my bills as it is. How am I supposed to save money first? And this is where the magic happens. When you commit to paying yourself first, your brain automatically adjusts. You find ways to make your remaining money work. You cut out subscriptions you don't really use. You cook at home a few more times per week instead of ordering takeout. You get creative with your spending because you have to. The wealthy understand something that most people don't. Your savings aren't what's left over after living. Your lifestyle is what's left over after saving. Read that again. Your lifestyle is what's left over after saving. This single mindset shift has created more millionaires than almost any other financial strategy. Start with just 10% if you need to. That means if you make $2,000 per paycheck, you're automatically moving $200 into savings before you touch anything else. Can't do 10%. Start with 5. The specific percentage matters less than building the habit. What you're really doing is training your brain to prioritize future you over present you, and that's a skill that wealthy people have mastered. But here's where most people mess this up. They save that money, and then 6 months later when something comes up, they dip back into it. The car needs new tires, so they pull from savings. They want to go on vacation, so they pull from savings. They see something on sale, so they pull from savings. And then they wonder why they never get ahead. The money you pay yourself first is not an emergency fund. That's separate. This is your wealth building fund, and it's completely off limits. Treat it like it doesn't exist. Pretend it's a bill you owe to future you, and future you is not someone you want to mess with. This money goes straight into investments, whether that's a retirement account, index funds, or whatever investment vehicle makes sense for your situation. The point is, it disappears from your checking account immediately and starts working for you. Now let's move into the second habit, and this one is going to sound almost too simple, but it's incredibly powerful. It's called the 72-hour rule, and it's going to save you thousands of dollars this year alone without making you feel deprived. Here's how it works. Anytime you want to buy something that costs more than $50 and is on an absolute necessity, you wait 72 hours before purchasing it. That's it. That's the entire rule. You see something you want, you add it to your cart or take a photo of it or write it down, and then you walk away for 3 full days. The psychology behind this is fascinating. Most of our purchases are driven by emotion, not logic. You're scrolling through your phone and you see an ad for these amazing noise-canceling headphones, and suddenly you need them right now. Or you're at the store and you see this jacket on sale, 50% off, and your brain is screaming that you're gonna miss out if you do not buy it immediately. That's not rational decision making. That's your emotional brain hijacking your wallet. When you implement the 72-hour rule, something incredible happens. About 70% of the things you thought you desperately needed, you completely forget about within those 3 days. Just forget about them entirely. And the remaining 30% you realize you can actually live without them. Maybe 5 or 10% you still want after 3 days. And you know what? You can buy those things guilt-free because you've thought about it, you've made a conscious decision, and it's not an impulse purchase. I started using this rule about 5 years ago, and I'm not exaggerating when I tell you it saved me over $10,000 per year. $10,000 that would have gone to stuff I don't even remember wanting. Stuff that would be sitting in my closet right now with the tag still on it or buried in a drawer somewhere. Instead, that money went into investments. And it's been growing and compounding year after year. But the real benefit goes beyond just saving money. The 72-hour rule trains you to be intentional with your spending. It builds a pause between wanting something and buying something, and that pause is where financial wisdom lives. Wealthy people have mastered this pause. They don't make emotional money decisions. They think, they evaluate, they consider opportunity cost. What else could I do with this money? Will this purchase bring me closer to my goals or further away? And here's a pro tip within this habit. During those 72 hours, calculate how many hours of work that purchase represents. If you make $20 per hour after taxes and you want to buy a $300 item, that's 15 hours of your life. 15 hours of waking up early, commuting, working, dealing with stress. Is that item worth 15 hours of your life? Sometimes it absolutely is, but most of the time when you frame it that way, the answer becomes crystal clear. The third habit is something I call income inflation protection, and this might be the most important habit on this entire list because it's the one that most directly determines whether you build wealth or stay broke no matter how much money you make. Here's the trap that catches almost everyone. You get a raise at work, maybe you get a new job that pays more, maybe you get a bonus or a promotion. Your income goes up by 20, 30, maybe even 50%. And what happens? Your spending goes up by the exact same amount, sometimes even more. You upgrade your car, you move to a nicer apartment, you start eating at better restaurants, you buy nicer clothes, and at the end of the month, you have the same amount of money left over as you did before the raise, sometimes less. This is called lifestyle inflation, and it's the silent killer of wealth. It's why people making $100,000 per year often have the exact same financial stress as people making $40,000 per year. The numbers are different, but the struggle is identical because their expenses have grown to match their income. Income inflation protection is simple. Every time your income increases, you save or invest at least 50% of that increase before you allow your lifestyle to change at all. Let me say that again because this is crucial. At least 50% of every raise, every bonus, every increase in income gets immediately redirected to savings and investments before you touch it. So if you're making $50,000 per year and you get a raise to $55,000, that's an extra $5,000 per year, about $400 per month after taxes. Before you start thinking about what you can buy with that money, $200 per month automatically goes to investments. The other $200 you can use to improve your lifestyle if you want, but half of it is completely off limits. This habit is how people build wealth regardless of their income level. I know people making $60,000 per year who are millionaires because they've been practicing income inflation protection for 20 years. And I know people making $300,000 per year who are living paycheck to paycheck because every time they make more money, they immediately spend more money. The beautiful thing about this habit is that it gets easier over time, not harder. When you first start, saving 50% of a raise might feel difficult because you're already imagining all the things you could buy with that money. But after you've done it a few times, something shifts. You stop seeing income increases as opportunities to spend more. You start seeing them as opportunities to reach financial freedom faster. And that perspective shift is priceless. Think about it this way. If you make $50,000 right now and you get $5,000 raises every few years, but you save 50% of each increase, by the time you're making $80,000, you're living on $65,000 and investing $15,000 per year. That's a massive investment rate, and you got there without ever feeling deprived because your lifestyle still improved along the way. You're just not letting it improve as fast as your income. Now, the fourth habit is one that makes some people uncomfortable. But I'm gonna be really honest with you. If you want to build wealth, you need to get comfortable with this. It's called strategic debt elimination, and it's not what most financial gurus tell you. The traditional advice is to pay off all your debt as fast as possible. Attack the smallest balance first, or attack the highest interest rate first. But either way, throw every extra penny at debt until it's gone. And look, I understand the appeal of that advice. Debt feels terrible. It's stressful. It keeps you up at night. The idea of being completely debt-free sounds amazing, but here's what wealthy people understand that breaks from that traditional wisdom. Not all debt is created equal, and the strategy for handling debt should be different depending on what kind of debt you have and what the numbers actually look like. If you have high interest debt, credit cards charging you 18 or 20 or 25% interest, absolutely destroy that debt as fast as humanly possible. That's not even a debate. High interest debt is an emergency. It's a financial fire, and you need to put it out immediately because every month you carry that balance, you're basically lighting money on fire. But here's where it gets interesting. If you have low interest debt, let's say a car loan at 4% or a mortgage at 3.5%, the math might actually tell you something different. If you can invest money and earn 7 or 8 or 10% returns, which is very reasonable with index funds over the long term, you're actually losing money by paying off low interest debt early instead of investing. Let me give you a concrete example. Say you have an extra $500 per month. You could put that toward your mortgage, which has a 3% interest rate, or you could invest it in a stock market index fund. Over 30 years, that same $500 invested will likely grow to over $600,000, assuming average market returns. If you put it toward your mortgage instead, you'll save maybe $70,000 or $80,000 in interest over the life of the loan. The difference is literally hundreds of thousands of dollars. Now, I'm not saying don't pay your mortgage. Obviously, you have to make your minimum payments. What I'm saying is that throwing extra money at low interest debt when you could be investing that money and earning significantly higher returns is actually costing you wealth in the long run. This is strategic debt elimination. You're making intentional decisions based on the actual numbers, not just on emotions or conventional wisdom. High interest debt gets annihilated immediately. Low interest debt gets paid on schedule while you focus on building wealth through investments. The key is being honest with yourself about what you can handle psychologically. Some people genuinely sleep better at night knowing they're debt-free, even if it's not the mathematically optimal choice. And that's okay. Your mental health and peace of mind have value. But if you can separate the emotion from the math and make decisions based on what will actually make you wealthier in the long run, strategic debt elimination is an incredibly powerful tool. And this leads us perfectly into the fifth and final habit, which is the one that ties everything together. It's called future self-clarity, and it's the habit that makes all the other habits stick. Here's the problem most people face. They know they should save money. They know they should invest. They know they should be smart with their finances. But in the moment, when they're staring at something they really want to buy, or when they're tired and don't feel like cooking so they want to order food, or when their friends are going on a trip they can't really afford, all that knowledge goes out the window because future you feels abstract. Future you doesn't feel real. Present you wants things now. Future self-clarity is about making future you as real and vivid as present you. It's about creating such a clear picture of where you're going and why you're making these sacrifices that saying no to present wants becomes easier because you're saying yes to future needs. Here's how you build this habit. At least once per month, you're going to spend 20 minutes visualizing and planning for your future in very specific detail. Not vague dreams like, I want to be rich, or I want to retire early. Specific, concrete, detailed visions. Where exactly do you want to be in 5 years? 10 years? 20 years? What does your life look like? Where do you live? What does your house look like? What do you do with your time? How do you feel when you wake up in the morning? What financial stress have you eliminated? What opportunities have you created for yourself? Write this down. Get incredibly specific. If you want to retire early, what age exactly? What will you do with your time? How much money will you need to make that possible? If you want to be financially independent, what does that mean in actual numbers? How much do you need in investments to cover your living expenses? Then work backward. If you need $1.5 million invested to retire comfortably at 50, and When you're 30 years old right now, that's 20 years to get there. How much do you need to invest per month to reach that goal? What returns do you need to average? Is it realistic? If not, what needs to change? This exercise transforms everything. Suddenly, you're not just randomly saving money and hoping for the best. You have a plan. You have a target. You know exactly why you're saying no to that impulse purchase or that expensive dinner or that upgraded car. You're saying no to those things because you're saying yes to retiring at 50. You're saying yes to financial freedom. You're saying yes to never worrying about money again. And here's what makes this so powerful. Every time you're tempted to break one of the other habits, every time you want to skip paying yourself first, or ignore the 72-hour rule, or inflate your lifestyle, you can pull out this vision of your future self and ask, does this purchase bring me closer to that person or further away? And when you've done the work to make that future self real and vivid and specific, the answer is usually obvious. I want you to imagine something with me right now. It's December 31st, 2026. The year is ending. You're looking back on the past 12 months. What would it take for you to feel like this year was a massive financial success? What would need to be true? Maybe you've paid off all your credit card debt. Maybe you've saved your first $10,000. Maybe you've started investing consistently for the first time in your life. Maybe you've increased your net worth by $50,000. Whatever it is for you, get specific about it. Now imagine the opposite. Imagine it's December 31st, 2026, and nothing has changed. You're in the exact same financial position you're in right now, maybe worse. You spent another year telling yourself you'd get serious about money, but never actually doing it. How does that feel? Really sit with that feeling for a moment. That contrast, that gap between where you could be and where you'll end up if nothing changes, that's your motivation. That's what's going to get you to implement these 5 habits, even when it's hard, even when you don't feel like it, even when everyone around you is spending money like it doesn't matter. Because here's the truth that nobody wants to hear. Building wealth isn't complicated. It's not about picking the perfect stocks or finding some secret investment strategy or getting lucky. It's about doing boring, simple, unsexy things consistently over time. It's about paying yourself first every single time. It's about waiting 72 hours before impulse purchases. It's about protecting yourself from lifestyle inflation. It's about being strategic with debt instead of emotional. And it's about keeping your future self so vivid and real that present sacrifices feel worth it. The people who get rich by 2026 aren't going to be the ones who know the most about finance. They're going to be the ones who actually implement what they know. They're going to be the ones who build these habits so deeply into their lives that they become automatic. They're going to be the ones who start today, right now, instead of waiting for the perfect moment that never comes. So let me ask you this. Which of these 5 habits are you going to start with? Because you need to pick one today, right now. Not all 5 at once because that's overwhelming and you'll quit. But one, just one habit that you're going to implement this week. Maybe it's setting up that automatic transfer so you pay yourself first. Maybe it's committing to the 72-hour rule for your next purchase. Maybe it is sitting down tonight and calculating how much of your next raise you're going to invest. Maybe it's making a plan to attack your high-interest debt. Or maybe it's taking 20 minutes to write out that specific vision of your future self. Second, there's the issue of the trade timing precision. When you analyze the timestamps of the major sell orders across both Shanghai and CME, they show a level of coordination that's statistically unlikely to occur by chance. We're talking about order placement that's synchronized within seconds across exchanges that are separated by 12 time zones and operate on different technological infrastructure. The probability of this happening organically without coordination is astronomically small. It is like watching 2 people in different countries flip coins and getting the exact same sequence of heads and tails 50 times in a row. Theoretically possible, but practically, you know something else is going on. Third, and this is perhaps most telling, the recovery pattern was just as suspicious as the crash itself. After the initial wave of selling drove prices down and triggered all those stop losses and margin calls, prices began to recover, but not in a natural way. Instead of a gradual climb back up as bargain hunters entered the market, prices jumped back up in sudden lurches, almost as if whoever had been selling suddenly reversed course and started buying. Some analysts have suggested that this is exactly what happened. The same entities that crashed the price were then buying back their positions at the artificially low prices they'd created, essentially profiting both from their short positions and then from the recovery. But here's where the story takes an even more sinister turn. And this is information that's been quietly circulating among professional traders but hasn't gotten much mainstream attention. In the days following the crash, several large physical gold dealers reported unprecedented buying activity from institutional clients. We're not talking about retail investors buying coins in small bars. We're talking about orders for physical gold in quantities measured in tons, not ounces. The timing is highly suggestive. Right after the paper price of gold got crashed on the futures exchanges, massive buying of physical gold occurred. This creates a disconnect that's fundamental to understanding the manipulation. Paper prices got hammered, but physical demand actually increased. That's not how normal markets work. In a normal market, lower prices should reflect either reduced demand or increased supply. But here we saw lower prices and increased demand, which suggests the price move was artificial. This disconnect between paper and physical markets has been growing for years, but this recent event brought it into sharp focus. The futures markets, where most price discovery happens, are essentially just contracts, promises to deliver gold or silver at some future date. Very few of these contracts ever result in actual physical delivery. It's estimated that for every ounce of physical gold that exists, there are probably 50 to 100 ounces of paper claims on gold through various futures, options, and derivative contracts. This creates a system where entities with enough capital can move paper prices significantly without having to actually buy or sell much physical metal. It's a vulnerability in the market structure, and there's increasing evidence that sophisticated players are exploiting this vulnerability systematically. The Shanghai connection adds another fascinating dimension to this whole situation. China's gold market operates somewhat differently from Western markets. There's much more emphasis on physical settlement, and the Chinese government has been actively encouraging its citizens to buy gold for years. The Shanghai Gold Exchange, which is different from the Shanghai Futures Exchange but connected to it, has been positioning itself as a potential alternative to London and New York for gold price discovery. There's a quiet but very real competition happening between Eastern and Western financial centers for control of precious metals pricing. This recent coordinated crash could be seen as a battle in that larger war. If Western institutions can demonstrate their ability to crash prices even in Asian trading hours, even on Asian exchanges, that's a show of force. Conversely, if Eastern buyers can absorb that selling and continue accumulating physical metal, that demonstrates their strength and resolve. Let me share with you some of the warning signs that informed observers had noticed in the weeks leading up to this crash, because in hindsight, the signals were there if you knew where to look. The commercial traders, which is the category that includes major banks and institutions, had been building record short positions in both gold and silver futures. This data is publicly available through the Commitment of Traders reports published by the CFTC, the Commodity Futures Trading Commission. When commercial traders are heavily short, it often precedes price declines. But the scale of the positioning this time was extraordinary, even by historical standards. Some analysts were calling it the most extreme positioning they'd ever seen. Additionally, there had been unusual options activity in the weeks prior, particularly in put options, which profit when prices decline. Large purchases of out-of-the-money puts, betting that gold and silver would fall significantly, were documented. Now, it's possible this was just smart money making informed bets based on technical analysis or fundamental views, but it's also possible, some would say probable, that these were positions being established by entities who knew that a major price attack was being planned. If you're going to manipulate prices downward, of course you'd want to have positions in place that profit from that move before you execute it. That's just basic front running, and while it's illegal, proving it in court is notoriously difficult. The regulatory response to this event has been, let's say, underwhelming. The CFTC has made no public statements suggesting they're investigating potential manipulation. The CME Group issued a bland statement saying that their systems operated normally and all trades were executed according to the rules. Chinese regulators have been even more opaque, offering no public comment at all. This regulatory silence is deafening to those of us who believe something seriously improper occurred. When you have a market event this dramatic, this unusual, this potentially damaging to investor confidence, you'd expect regulators to at least announce they're looking into it. The fact that they're not suggests either incompetence or, more troublingly, complicity, or at least willingness to look the other way. Now, I want to address the counter-arguments here because it's important to be fair and consider alternative explanations. Skeptics of the manipulation thesis would point out that markets are volatile, that large price moves happen, and that correlation doesn't necessarily mean coordination. coordination. They'd argue that maybe there was some fundamental factor that drove the selling, something subtle that most observers missed. Perhaps there was concern about emerging economic data from China. Maybe there were whispers about Federal Reserve policy that spooked investors. It's possible that this was just a case of herd mentality, where some initial selling triggered algorithmic trading systems that amplified the move, creating a feedback loop that crashed prices without any deliberate manipulation. These are fair points, and I want to acknowledge them. Markets are complex systems, and sometimes complex outcomes emerge from relatively simple inputs without anyone pulling strings behind the scenes. However, the counter-arguments don't adequately explain several key facts. They don't explain the precise timing coordination between exchanges. They don't explain the absence of any fundamental catalyst. They don't explain the specific pattern of stop hunting that was observed. They don't explain the immediate surge in physical demand. Pick one. Master it. Let it become so automatic that you don't even think about it anymore. Then add the next habit, then the next. By the middle of this year, you could have all 5 of these habits running on autopilot, and by the end of 2026, you could be in a completely different financial universe than you are today. I've seen this transformation happen over and over again. People who felt completely stuck financially, who thought they'd never get ahead, who were living paycheck to paycheck despite making decent money, and then something clicked. They stopped looking for complicated solutions and started implementing simple habits consistently, and everything changed. You can be one of those people. You can be someone who looks back on 2026 as the year everything shifted, the year you finally took control, the year you stopped making excuses and started building real wealth. But only if you start now, only if you take what you've learned in this video and actually use it. The information means nothing without implementation. You can watch 1,000 finance videos and read 100 books, but if you don't actually change your behavior, you'll end up in the exact same place. So please, I'm asking you, pick one habit from this video and commit to it today. Write it down, set a reminder, tell someone about it to create accountability. Do whatever you need to do to make sure this doesn't just become another video you watched and forgot about. Your future self is counting on you, that version of you who's financially free, who sleeps well at night, who doesn't stress about money, who has options and opportunities and security. That person is depending on the decisions you make right now, today, in this moment. Make the decision that future you will thank you for. Start building these habits now, and I promise you, by this time next year, you'll be amazed at how far you've come. Thanks for watching, and I'll see you in the next one.